Hello, I'm Robert and welcome to my channel, where I discuss everything automated algorithmic trading, or simply algo trading. At the end of every month, I like to go through all of my trading, both demo and real, and take an assessment on what I did right and what needs improvement. And this month is no exception to that. We've seen this table before where I compare all of my different trading strategies, techniques, and settings and see a lot of differences. And one thing that stands out, the shining star of last month, is Strawberry Delight EURUSD, $126 of profit in 1 month. Now, the interesting part is the highest exposure on this account is about $121. So that means I made literally double what I actually had exposed. That sounds like something that I should adapt my trading to immediately, considering when you go down to my real money account, I only made $23 last month. So I lost out on $100 of profit. Or did I? The sad truth is we can see from all the information already that this is really fool's gold. And sadly, I already know this from experience because I have made this mistake previously. And not just once. My patrons have already seen my real money account where I took a $300 budget, made an additional $350, and then I ended up losing $450 of that budget. So I literally took the budget, doubled it, and then lost it. All because of this little deceptive nuance. And that is really the whole thing that needs to be looked at in trading. And the table already shows you exactly why this number is a lie. We can see right now that we have no stop losses. But we see here 4 stop losses, Strawberry Delight on another pair. And the amount earned is literally half. Same account, same settings, but because of market structure, 4 stop losses wiped out 50% of the profits. And we can see right here 41 stop losses with only $16. A few days ago, this account only had $1 above the budget level. We can see here 37 stop losses, only $33 of profit. And we can see another Strawberry Delight, 7 stop losses, only $30 of profit. This is the gimmick that makes trading deceptive. When the market goes in your favor and it looks really nice, you think this is the way to go. You finally found what you can build on, what you can make realistic, real-world returns on, only to have the market come up 4, 5, 6 months later and take it and more back. This is why worst-case scenario planning is absolutely critical. You see, Strawberry Delight, even though I have a large number of levels, the spread between the levels is only 2 to 3 pips. We're going to keep this simple and just say 2 pips on average. I have 70 levels. My market depth is 140 pips. The average for this market for a single month's movement is about 480 pips of movement. So you can see just how quickly some of these pairs will be destroyed. And in fact, we can even see that in a picture. Let's take a look at French vanilla. EURUSD, so we have an apples to apples comparison. 41 stop losses. And right now it is only sitting at $16 above break even. So let's actually see what that looks like. We are now looking at the equity chart of French vanilla EURUSD. The zero line is how I measure profitability. Anything below zero cuts into the budget I started with. So this is money off of my original budget. This is money earned on top of my original budget. And we can see that I made $30 very quickly. But then I lost $50 in stop losses when the market moved against me aggressively. It began to recover, and then another round of stop losses. And now it's recovering again. But this is exactly the whole point of why I know Strawberry Delight at 140 pips of market depth is going to do the same thing. My patrons have already seen my real money account that shows this. So if you're not subscribed, you're missing out on a whole bunch of good material. I'll leave the link in the description. But for the purposes of what we see here, worst case scenario planning illustrates just how bad things can get. Because lo and behold, it happened. And it will always happen. The market will always go against your position. And when it does, it's going to burn. When you're dealing with any kind of trading approach, if you don't take a look at the market and measure the average market movement and accommodate that situation, you are going to lose money in the long run. Always. If you can't weather what the market would normally move, you're going to lose money. No ifs, no ands, no buts. We can see. You would think that 4 stop losses aren't that bad. But they are. Remember that a stop loss only guarantees that you're going to get out at a particular point or lower. A stop loss is a market order. And in this case, we can see the market must have been moving pretty fast because it took a huge chunk out of the profits. Stop losses are an absolute requirement for 99% of all trading techniques. Only if you're using a pure accumulation technique with a ladder or staircase style risk mitigation approach and quite possibly hedging should you trade without some kind of a stop loss technique. Jackrabbit TV is an example, but you need to test it, you need to make sure your budget is right on par, and you need to take the time to run multiple cycles to make sure that your worst case situation will be protected. And your worst case situation will occur. I guarantee it. Because we can actually see it with live test data. So for me, only making $23 last month of profit, knowing that I can handle the market movement of a full month without worrying about prices shifting too drastically, is fine. Because I know over time I've made more than anybody that falls into this trap. and I have fallen into this trap. I know how much it hurts. I know the feeling of the exuberance of seeing your account literally double within 3 months, only to have one single day wipe you out of all your profits, and they began to cut into your main budget and take that too. It's a gut-wrenching blow. Don't make that mistake. The market will always go against you. That's why a worst-case scenario plan is critical. If you know what the market is going to do, you can plan for it, you can calculate it through probability and statistics, and you can put the market on your side by knowing that situation. In my case, with what I have on my real money account, I have a 60% probability of success. And that is backed up by actual market data going back 21 years. That's the whole point that you need to think about. That's the whole point that you need to focus on as you develop your trading technique. And this doesn't matter if you trade manually or if you trade algorithmically the way I do. You have to look at your worst case scenario. You have to look at the probability and statistics of which way the market is going to move and by how much. That analysis doesn't come easy. It takes time to figure out those numbers. But taking that time to understand your market can prevent you from losing large amounts of money. So, if you're not subscribed to my channel, please do so. Please like this video if you found it interesting and informative, and help others learn the real way of trading, not the garbage that flutters the internet. And if you want to see my inside details of my real account and other information I post, please subscribe to my Patreon. If you have any questions, please leave them in the comments below. Thank you for watching.